Welcome to our special edition webinar where my name is Matthew Cassidy, Managing Director, and I'm joined with Jonathan Bayes, our Chief Investment Officer. Thank you for your time, and we're looking forward to exploring the impact of coronavirus on our clients and our portfolios, and specifically what we're seeing around the world. Jono, what are you seeing out there? What's happening in investment markets? Why have we seen such a large sell-off, and how are we looking moving forward?
Clearly it took a lot of people by surprise. Even a month ago when this was going on in China, I don't think any of us envisaged that we'd have to sit 1.5 meters away from one another and we'd be stuck at home with our loved ones for an indefinite period. So the surprise element is one. Markets were really pretty optimistic at the start of 2020. The trade deal had been done. We were seeing re-acceleration in US growth. So we've had to really rethink investment thoughts for one. The second issue is it's a really human crisis this time. It's not just a financial crisis. This is one where huge numbers of people are seeing their household and corporate cash flow stop immediately on account of the quarantining, which is a really difficult thing for us to put into an investment context, notwithstanding clearly the huge human issues of that as well. So it's a rapidly moving feast, and unsurprisingly, expectations for how it plays out in markets are changing on a day-to-day basis. Only 2 days ago, Goldman Sachs were calling for the US economy to contract by 25% in the second quarter, which would be the biggest contraction in US economic growth in history by a factor of 2.5, and that the unemployment rate there could go from a 50-year low of 3.5% to 9% before the end of the year. So just a huge change in basis.
Yeah. What are our concerns at the moment? Obviously, the US market obviously leads a lot of sees our market performance.
Yeah.
What are we seeing over there? What are the concerns?
Yeah. The number one concern for everybody right now, as it always is at a time of fear, is liquidity. And so again, we've made the point in several publications in the last couple of weeks, return of capital has become the preeminent fixation of investors, not return on capital. Fortunately, the portfolios that we've got are really quite liquid, which is good, which puts us in good stead for arguably redeploying that in the time to come. But the big focus that anyone who's followed the markets knows, the big focus for us is how the US gets through the next few weeks as the infection rate really goes exponential, and the Americans don't tend to care so much about anything if it happens beyond their shores, but when it happens in America, it's a big deal. And as the biggest financial market in the world, the fact that we're yet to get the bad news, I think, coming through on the virus and the infection rate, and unfortunately the mortality rate picking up there, means that certainly in the US, I think that the markets are yet to find their low point. We've probably got another rocky couple of weeks to come.
Yeah. We've obviously heard some reports out of the US as well, as that possibly this was actually there a little sooner than most people were thinking. It possibly could have been a flu or the like, and clearly there's a lot of unknowns around the world. But what about on the positive side? What have we seen out of the fall off of cases in China? Some of the Asian countries, including Singapore. Yeah. This has obviously been a contained issue, and therefore some of those economies are getting back to normal.
Yeah. I think that's the positive here in Australia, that we believe, whether you believe it or not, we feel like we're starting to get quite proactive. We're extremely fortunate that we're a major country with low population density and a huge amount of ocean separating us from the rest of the world. So I feel very confident that as a country we will get through this in a relative sense a lot faster than those in Western Europe and the United States. And it's actually one of the reasons why we've become more positive, I think, in the past week on Australian assets relative to global assets. We've been a really big underperformer as a country. The fall in the Australian dollar has exacerbated that. But I feel like looking forward from here, it's appropriate to start to look a bit more positively at the economy here, at the currency, and indeed at the share market.
Yeah. The governments around the world, and I think particularly in the domestic front, have provided incredible stimulus over over a really short period of
Yeah.
time. I think we got something on Saturday, we got something on Sunday.
Yeah.
An explanation of how we're seeing those playing out. I mean, is this going to be a short-term injection, or do we see there's going to be further stimulus packages as we move forward? Any comment on that?
Hard to know. I mean, the stimulus is unprecedented. So if we were giving the governments a hard time for their speediness or readiness in preparing for the health issues that came with this, they certainly haven't been slow on the fiscal side of things globally. As to whether the stimulus is anything other than holding back, the dam from breaking, remains to be seen. But the stimulus package from the government here in Australia, the RBA as well, fueling the bank's ability to lend. In the UK, 350 billion pounds worth of stimulus there. The promise to guarantee 80% of salaries is again unheard of. Paychecks in the United States being deposited direct into people's accounts is being talked of in the US with a $2 trillion stimulus. So on that front, it's been terrific, but people aren't going to spend this when they're in a position of fear, and when you lose your job or you lose your livelihood or your business stops, you instantly go into defensive mode. The evidence post the GFC was that savings rates in all the big countries escalated and skyrocketed for a couple of years because people said, well, listen, I'm not going to let that happen to me again. I'm going to save for a rainy day. So it's hard to know just what effect the stimulus will have, and when in fact these checks start hitting people's bank accounts as well. And then the debate then becomes too, well, when do we finish with the quarantining? I think in Australia it'll be sooner than it is elsewhere. But then what sort of economy do we rebound back into in the second half of 2020?
Yeah. Given these issues, how have our portfolios performed? Like what's of concern? What are we comfortable with? And we've obviously communicated recent times we had a larger, probably the largest allocation of cash we've ever had in our portfolio. So how's that playing out at the moment, Jono?
Well, usual story for me, mate. As you know, I'm never 100% happy with things. Fortunately, the asset allocation has worked out well for us. We took some money off the table in January. We have had some reasonably sized cash positions, which is fantastic. So the defensive weight we've had in the portfolios has been a real help. Aussie equities have underperformed the bond market by about 35% in the last 5 or 6 weeks, which is a huge move. We've been overweight international equities, which has been a godsend given the currency has obviously fallen to 56, 57 cents, 58 cents or thereabouts this morning. So that's been a real ballast against a greater loss on the international side of things. On the Aussie equity portfolio, unfortunately, we've given back all of the outperformance we had in the second half of last year, which has been a frustration. But I do feel confident that the local portfolio will rebound well when the markets bottom out in the next fortnight or so, and that we can actually do a good job of actually upgrading the portfolio in the coming month or two as well. There's some really good companies that, frankly speaking, there's some good value in the market right now. The issue isn't the value in the market, it's liquidity, and when people actually stop panicking, if you will.
Yeah. It was an interesting call this morning with one of our fund managers out of Laguna Beach, California, the CEO of WCM Investment Management. And we were talking about companies like Berkshire Hathaway and Warren Buffett having $160 billion to spend, and the fact that this money will be deployed in this type of market. John, what do you foresee that we could stay at these levels for a prolonged period of time? Like what would be the catalyst as to keep markets at this level and really confidence exacerbating?
So the speed with which we exit the quarantine, that's the first and foremost thing. Then the speed with which we discover a treatment or a vaccine, if you will, is another. Will be the key to restoring confidence in the economy. Once that's established, the amount of stimulus that's being thrown into the economy should really help, I would say, quite a vigorous rebound. And so we're probably taking the view that once we get the final capitulation in markets, and we're following the US and the infection rate in the States as our really key driver, when we get to that point, we would think that there's probably a good 20 or 30% rebound in short time from equity markets as people regain confidence, in the equity market. They move back out of cash. They see the good long-term value. Perhaps they have some confidence that, again, as an island nation here in Australia, that maybe the damage won't be as significant here as it is elsewhere.
Yeah. One of the other key emotional considerations at this point is, putting your money into the market when it just feels like there's so much negativity. In the event that the recovery plays out as we foresee it, what's the emotional side of investing at the moment? Clearly,
sure. It was huge. I mean, the market is influenced by the same people who are at your supermarket buying all the toilet roll a month ago. I mean, this is human behaviour, and it is hard to go against the grain. But on the positive front, we are now 35% lower than we were 6 weeks ago. This is an interesting one that we were talking about earlier, Matt, the so-called Schiller PE, which tries to smooth out earnings over a longer period of time. So the Schiller PE in Australia, which smoothed over a 10-year earnings period, takes the average, only has us about 10% above the low point we got to in the GFC. So we don't look expensive at all. We certainly don't look expensive against the government bond market where 10-year yields are under 1%. The other big thing that we've talked about the last couple of days too, with collapsing interest rates and QE, people need to find income in many different ways to sustain themselves, and it's got harder with so-called defensive assets with the collapse in yields. So again, with the pullback in many of these shares, good quality shares in fact, even with earnings downgrades, there's going to be some great buying.
What about some of the listed investments we're in at the moment? Some of the fixed interests. We're just seeing some pricing at the moment, which is at unbelievably cheap levels.
And this hopefully should give our investors some confidence, albeit that the share prices, can be scary when they fall the way that they have. But there's been a lot of focus, a lot of issuance over the last 18 months, which has brought the focus on listed investment trusts, particularly in the fixed income area. And many of these things are trading at 30, 40, even 50% discounts in a couple of instances. I would say in some instances, deservedly. We think that we're in the good, high quality ones. And again, a shout out to the managers of those trusts, both Metrics and Qualitas. The liquidity that they offer investors is a positive, but at times like this it can be a negative because people use that liquidity and sell it aggressively. And back to your earlier point about human behaviour. But in the instance of the Metrics Master Income Trust and the Qualitas Real Income Fund particularly, these pullbacks we think are providing huge amount of opportunity, and maybe at some point we might take advantage of that. The quality of the underlying earnings, particularly in the Metrics Master Income Fund, being very majority senior secured. Real estate loans with really strong equity protection. Again, LTVs on these things are about 60%, 65%. Equity support on the private equity side of things as well. It's not to say that there won't be haircuts, but it will be very, like classic example, Matt, 140 loans in the Metrics Master Income Trust. So 0.7% the average exposure to each credit. Now offering a running yield of 8.5%, where it was this morning. Qualitas, the stock was being beaten up a little bit a month ago because they hadn't put the money out. And yet the shares are at $1 from $1.60, and we think that these guys are really high quality issuer, and so currently you're getting on a running yield of 9%, but they haven't even invested all the money. So I'd like to put a little bit of confidence out there in the underlying asset quality of these listed investment trusts, and the fact that we think that the partners' clients are really in the good ones.
Yeah. What are we looking at to deploy the cash at the moment?
Yeah.
What are some of the names we're looking at to get ready to invest in?
Yeah, so it's hard to know, but to give a rough idea, so the decisions we need to make going forward, which we're yet to resolve, but when we unwind a little bit of our short Australian dollar bet, we're starting to move one of the international funds from the unhedged to the hedge because the currency at these levels. We've got some of that defensive allocation of cash we can put potentially back into the equity market. We should take a look at in the coming couple of weeks. Again, who knows what we decide, but that's a decision for us as well. But then in the fixed income space, the ARDIA Real Outcome Fund, I think we think, I mean, it was described on their conference call the other days by the fund managers that this is the best opportunity set they've seen for relative value fixed income investing in their careers.
Yep.
So that's a great endorsement. The listed investment trusts you just flagged earlier, Metrics and Qualitas, look really pretty fantastic value at these levels too. And then some of the companies that we've had that have been beaten up that really I think are still good quality companies with great balance sheets, like Pendle as an example. I think, certainly at some point Altium and NextDC will be great stocks to add to as well. We love the Afterpay story. It's in a bit of a pickle at the moment given that its customer base is clearly going to struggle. The consumer outlook isn't going to be great, but the underlying business of Afterpay, I'm sure, is worth significantly more than it currently trades at. It just might take them a little bit longer before the share market responds to that. But I mean, again, the banks are trading below book value for the first time since the early 1990s. Macquarie Bank has underperformed the big banks, now trades on a single-digit PE. Again, all of these companies are going to see some earnings downgrades, but the relative value is starting to emerge. To be honest, I think there's maybe not a shopping list of things, but we are starting to get to the point where, in the next 3 or 4 weeks, we will certainly start to put that cash to work.
Yeah, great. Any final comments on the next 2 to 3 weeks? We're obviously watching the US, well aware of the spread of COVID-19 in the US, hoping that doesn't spike. Hopefully we start to get that flattened out. And any comments on the point at which we call the low point in the market? Very hard to do, of course.
Yeah, and I've tried it too many times and never been right. Listen, I think it's going to, in Australia, we're pleasantly going to surprise ourselves with how well we get through this. And I don't say that flippantly, given that I know, sadly, a lot of people are still likely to get sick relative to the rest of the world. But in the United States, I think it's going to be a very difficult couple of weeks, regretfully. And it will be how they handle the next fortnight that determines where the low point in the market lands. And remember, of course, it's not a valuation thing, it is a human behavioural thing. So if things look a bit worse than we anticipate, then the risk is that we could overshoot further on the downside, and vice versa if they do a better job of it. But I do think it's crunch time the next 2 to 3 weeks, and I'm hopeful that when we speak, we'll speak many more times in the next 2 to 3 weeks, but when we speak in a fortnight or 3 weeks' time, that we're actually looking to come out the other side.
Fantastic. Obviously, it's a really challenging time for a lot of people out there, as a lot of people have lost their jobs, etc. Yeah. If there's any way our Greater Wealth business could support any of those people, we're certainly here for you. Please make contact with your principal advisor. Thank you very much for listening, and we'll look forward to providing a further update in due course. Take care. Thank you.